While U.S. markets show surface-level stability, a deep divergence is opening up globally. Major indices in Japan and South Korea have recently dropped by nearly 8 and 10%, signaling a mounting liquidity drain. This pressure arrives just as the market's primary support begins to fade, with the start of the corporate buyback blackout. Nasdaq technicals are centering on the 595 to 600 range as a critical floor. This comes as corporate support fades. NANA reports that nearly 80% of firms will be in a buyback blackout by month end. We're also seeing a sharp move towards safety in the institutional space. Bank of America survey data shows fund manager cash levels jumping to 4.3%, the fastest increase since the pandemic. Additionally, Bella reports Goldman Sachs estimates of up to $100 billion in potential selling pressure from trend-following funds over the next month. As corporate buybacks hit a wall, the Nasdaq is approaching the 595 to 600 range as a critical technical lifeline. NANA reports that 50% of U.S. firms are already restricted from repurchasing shares, a figure expected to reach 80% by month end. This liquidity drain pairs with a surge in institutional caution. Bank of America's survey data shows fund manager cash levels jumping at the fastest rate since the pandemic. A major split is forming in how tech giants approach AI. Companies like Amazon, Google, Meta, and Microsoft are doubling down on infrastructure, with Joseph Carlson projecting a collective $700 billion bet on data centers this year alone. This heavy spending is a world away from Apple's strategy, which focuses on running AI models directly on the device using its new chips. A significant divide is opening up in how big tech approaches AI infrastructure. Joseph Carlson highlights a projected $700 billion bet this year from Amazon, Google, Meta, and Microsoft. This massive spending on cloud data centers stands in sharp contrast to Apple's localized strategy. With the new M5 chip, Apple is focusing on running large AI models directly on devices. This approach aims to protect their margins while avoiding the heavy infrastructure costs that the rest of the industry is currently taking on. Nvidia is shifting its business model from selling chips to providing the core infrastructure for the AI economy. At the GTC conference, management announced a $1 trillion revenue target for its data center segment through 2027. This move positions the company as a central utility grid rather than a traditional hardware vendor. Bella reports that this pivot focuses on capturing the long-term scaling needs of the industry. To defend its currency, Bank Indonesia has already capped dollar purchases at $50,000 per month. These stresses are forcing central banks into increasingly difficult choices. The Reserve Bank of Australia, for example, raised rates a second time while citing oil-driven inflation. According to Eurodollar University, this mechanism is triggering a global dollar margin call, where scarcity becomes an active drag on markets as countries scramble for cash. While public markets appear resilient, analyst Sven Carlin is flagging hidden credit cracks in the private sector that he warns could echo the scale of the 2008 crisis. He highlights Berkshire Hathaway's defensive posture, specifically its $370 billion cash pile, as evidence that major institutions are bracing for a systemic shift. Analysts like Sven Carlin are warning of hidden credit cracks in the private markets that some fear could mirror the 2008 crisis. Carlin points to Berkshire Hathaway's defensive posture as a clear signal. The firm is currently holding a record $370 billion in cash, suggesting that major institutions are bracing for systemic shocks, even as public indices appear resilient. Turning to the signal sweep, we have a significant report on SoFi. NANA reports that short seller Muddy Waters is targeting the company, alleging $312 million in hidden debt and fictitious profits achieved through manipulated loan valuations. On the regulatory front, Joseph Carlson highlights an SEC proposal that could eliminate quarterly reporting, a move that would fundamentally change market transparency. Finally, we're seeing a severe shortage in the memory chip supply chain. Analysts note that the current DRAM and NAND crunch is starting to mirror the Nvidia GPU bottleneck from 2 years ago. In this signal sweep, NANA is tracking a short seller report from Muddy Waters targeting SoFi, which alleges hidden debt and manipulated loan values. On the regulatory side, Joseph Carlson notes an SEC proposal to eliminate quarterly reporting, a move that would significantly change market transparency. We're also seeing a severe shortage in memory chips, mirroring the Nvidia GPU crunch from 2 years ago. Finally, Bella reports that if regional tensions ease, oil could revert toward $50 a barrel, with recent tanker movements already showing signs of easing pressure. The risk outlook for the coming weeks centers on the 50% threshold. A Moody's model suggests the probability of a U.S. recession has crossed this midpoint, following the escalation in the Middle East. For traders, SMB Capital points to capital velocity as a key metric. They note that closing option spreads early can often be more efficient than waiting for final decay. The next few weeks will serve as a determination period for technical floors and the broader economic trajectory. Goldman Sachs estimates that if geopolitical risks persist and financial conditions tighten, the S&P 500 could reach a downside target near 6,300. All sources and citations are in the description. Subscribe for high-signal daily recaps.